Guys, is the sound higher now? Is it better now? Yeah, it's better. Okay, great. That sounds good. Okay, wonderful. So as you can see here, Aussie was one of the beneficiaries of that weaker dollar. I'm going to show you the dollar index just to give you a brief overview of what the dollar was doing and just how it's performed, because those of you who know, who have joined my webinars before, the dollar index, it's not always the best one to trade, but it can be a really nice overall kind of litmus test, if you like, of what the dollar's doing, which can really help you in some of your other trades. So as you can see here, it's weak, right? It backed away from the 81 level, didn't even get close to the yellow part, to this yellow line here, which is the 200-day moving average. And indeed, the 200-day moving average is kind of flatlining to slightly weaker. So that suggests that we're still kind of in a range, but the short-term bias anyway is for slightly lower dollar index, and that's been supported by some of the momentum indicators as well. So as you can see here, we're still hovering around this 50 to 60 level, which is a key support level. In the past, it has been a resistance level, but for now, it's a support level. So we're just hanging on to that level. Obviously, the best over this week, we'll be looking at weekly close, whether or not we can stay above or below it. Some of that will depend on some economic data. We have CPI data, and we also have the all-important retail sales data as well. Good test of how the US consumer is doing. That will all feed into whether or not we stay above or below these cluster of lines here. So that pink and green line. Fabrice, it's your first time here. Thank you very much for joining. Alan, I'm going to talk about dollar yen. I've just sent a piece out on dollar yen. So let me just email you or just send you guys quickly the piece. So as you can see here, this is it. So you probably saw the title, Fundamentals are Still in Favour. And I will show you a couple of other charts that I've got here. Fundamentals are still in favour. However, there are a good few hurdles to cross in dollar yen. So dollar yen is a big contributor to this dollar index, by the way, as well. So this is the fundamental side. So this is what I'm kind of basing things on, or this is what I'm looking at and using to justify my view. One of the things I'm using to justify my view that the fundamentals are still intact. This is the trade positions for Japan and also for the US. The first thing you'll notice probably is that they're both in deficit. The red line is the US, the blue line is Japan. And as you can see, they're moving in absolutely opposite directions. So as Japan's has been trending lower, the US's has been trending higher. And that's really come into sharp relief for the month of November and October. So when Japanese data just got worse and worse, US data really picked up quite strongly. Broke above kind of, highest level since 2009, based on kind of lower oil imports. It's the US story of the US being, this major oil producer, which is really helping that. And why does this matter? Well, things like, trade balances or balance of payments is one factor that can, weigh on or can have an impact on a currency. We've seen that with the euro. The euro's had an improving balance of payments position over the last kind of 12, 15 months, and that has corresponded with a higher euro. And that could potentially be the same for the dollar. Now, these type of trends, they don't play out overnight, and that's why if you read my piece, you'll see that's more my kind of medium-term trend. In the shorter term, there's a slightly more concerning correlation, I should say, which is having an impact on dollar yen. It's dollar yen and stocks. Now, this is dollar yen and the S&P. So dollar yen is the blue line, S&P is the red line. But you could use dollar yen and Nikkei. Correlation is very, very strong and statistically significant. It's 78% since the start of this year. So 78% of the time, dollar yen is moving with the stock market. And that is something that you need to watch out for two reasons. Number one, stock markets are being a bit erratic. Those of you who were trading the market early in the European session yesterday will have known that European stocks opened higher. US stocks, they didn't react immediately to the non-farm payrolls report. They were higher on Friday. Likewise, European stocks started higher, and then in the afternoon of the US session, it was kind of like a rout. So stocks came off, as you can see, quite sharply, back down to that kind of, or very kind of, back down to that kind of 1820-ish level, and that dragged dollar yen down with it. Got to a low, sub 103 low at one stage. So just some mixed messages, and because that relationship is so tight, it is tricky to trade it. Added to that, we also have key earnings releases coming out this week. So that is really kind of weighing on or limiting dollar yen upside in the short term. So, Alan, to answer your question, what is my view on dollar yen? I still think that any dips will be faded by the market. Some key levels, which I point out in my piece. Let me just pull that back up again. Oh, here we go. Some key levels I mentioned. 102.60 is the 50-day moving average. I'll just bring that up for you here. We try and put these two together. Actually, I'll just talk you through where I think things are going to go. 102.60, 50-day moving average here. That is your first line of defense or first support level. The second level, let me just draw this on here. Bear with me one moment, guys. From Oct low to the early January high, it's 102.05, 38.2% retracement of that up move. And then the upside resistance remains 105.44, which is the 2nd of Jan high. I also have you can get some deeper technical analysis by looking at my colleague Chris Teddo put a technical piece out on the dollar index. On dollar yen earlier during the Asia session. Kiwi USD is broken out high. What is the possible target? Yes, Kiwi is an interesting one. I just want to show you one quick chart as well on Aussie. Am I looking at Kiwi now? Bear with me one moment. Aussie Kiwi, I just want to show you really quickly. Let me just go back. So as you can see, broken lower. The Kiwi really is having a massive push higher. That was noted by my colleague Chris Tavere yesterday. In our pieces, he was looking at it. Did look quite ripe for a bit of a testing. Now the Kiwi, by far the strongest performer now in the commodity block. So doing very well against the Aussie, and very similar picture against the CAD as well. Let's just go back to a few years. Take this sort of long chart. I'm going to take a daily chart, or a line chart here as well. Fine. Just get a line chart up because it's just slightly easier to see. As you can see here, we're at significant levels. We're very, very close to the 2005 low. And then below there, it takes us all the way back to kind of 1997. Kiwi, very, very strong. Looking at Kiwi dollar here. In fact, I was talking to my colleagues yesterday, and we were just going through kind of, what to expect. Obviously, there's the end of January is going to be a really busy time, or it could potentially be a very volatile time for Kiwi dollar. And that's because within about 2 hours of each other, we get the FOMC meeting decision, and we also get the New Zealand, the RBNZ decision. That really is worth looking out for. Obviously, this break now above 84 is significant. And it leaves, you know where I'm going to say, don't you? These are October highs here come in around about that 85.5 level, just ahead of 86, which was quite key resistance. But 86 has been really key resistance. We did pop out of there the 4th, what date was it? April 2013. We got to 86.76, but we didn't really last long there, and that actually was kind of the top. We have broken out of this range. This has been quite a frustrating trading range. Just the last 3 sessions, the Kiwi really is one of the big beneficiaries. And I think it's largely due, when you look at it from a technical standpoint, we could push a bit higher, but why have we kind of, why is it the Kiwi in particular? And I think it's because the US is doing very badly against countries where the central bank isn't dovish, and the Kiwi dollar, the RBNZ in New Zealand, they're not dovish. In fact, if anything, they could be the first bank to hike, and that's why all this pent-up aggression, if you like, in the Kiwi dollar, where we've seen it kind of just trade sideways for the best part of 2 months, has just been released, and what we've seen is another nice push higher in the Kiwi dollar because of the relative central bank stance, really. Okay, so QE and US tapering, RK trader. This does play into this chart, or play into this New Zealand dollar piece. And the reason why is that we believe that, you know, the US is going to look through weak non-farm payrolls numbers. Yes, they were weak, obviously 74,000. I mean, that was dreadful. However, on the upside, we think it's a blip. It's probably statistically, you know, it could potentially be either revised away or, you know, we'd be looking for January's numbers. In fact, the beginning of February is going to be really important. Ian, you're going, yeah, that was terrible. It really was a dismal number. But it could be reticent, or it could be a sign of two things. Number one, that the weather could have had an impact, even though, you know, I've spoken to a few people and they think that's unlikely. A Christmas hangover, that could be one of the things. But it could also be that December is just a lousy month to get a job. Basically, all the holiday hiring has been done in November. And, you know, a lot of people, they're going away. Christmas has become a 2-week break these days, so that can impact December jobs numbers. So December's always a funny month, so is January actually. So we would not be surprised if, you know, these moves, yes, they are significant in the dollar, but they could be short-lived. And hence why, you know, with the Kiwi, for example, you know, we could get up to that 85.50. It does look very, very strong right now. But you need to have another, there needs to be another kind of fundamental driver. You can't just be, you know, for me anyway, with dollar pairs at the moment, there has to be a fundamental driver pushing them higher. So you can't just, you know, for example, the Kiwi isn't just moving higher because of dollar weakness. It's also moving higher because of its relative central bank stance. For example, dollar yen, yes, it's come off. For sure, but we think it will go back up again because we just don't think that the yen side of that equation has the fundamental oomph to really weigh for the long term on dollar yen. Kamikaze, I'm going to talk to you about earnings season in a moment, but I know someone was talking about the Aussie and cable. Sterling yen, sorry. I will look at that in a moment. What do you think about parity with the Aussie? I'm assuming what you mean here, Peter, is Aussie Kiwi. I think there's definitely a definite I mean, there certainly is a possibility at the moment. However, it will all come down to relative economic performance. Right now, you know, essentially, whereas, you know, in this part of the world, New Zealand is a small economy, right? So when New Zealand relies on Australia, I think that there's no way that it will get to parity, really. Because I think before that, I think the RBNZ will have stepped in massively to try and weaken their Kiwi, largely because Australia is their largest trading partner. It's really important. So is China. China's slowing down. Australia is certainly slowing down. It's not looking as strong as it was, that's for sure. So in this environment, you know, the RBNZ, the risk is obviously if the Kiwi gets too high, the risk for across all Kiwi crosses is going to be the RBNZ intervention of some kind. Someone was looking for Aussie, so I'll talk about Aussie first, that's right, and then I might talk about sterling yen because I want to talk about sterling overall. Do I see, okay, I know you're looking at some sterling strength. What about rate hikes, Peter? I think you're thinking about rate hikes from the RBNZ. Indeed, I do believe that they could hike rates, but they're not going to want to do that and hurt, because that's largely to target the housing bubble. They're not going to want to do that and hurt all the other sectors of the economy, including their important exporters at the same time. We just don't see that as being too important. Alan, you're looking at Aussie. Yeah, let's do some live kind of Aussie trading. Aussie is very weak right now. Again, possibly being pushed lower actually. By what's been going on with the Kiwi dollar and what's been going on with Aussie Kiwi. So yes, just got below that 90 level. Here, though, if we get around about this kind of, you know, 88.50 level is really, you know, a very strong level of support. But obviously, if we get back down there and we break below there, that's a very, very negative situation for the Aussie to be in. I probably wouldn't have wanted to be an Aussie bull right now. I sent out a piece yesterday about how long the roll could last, and I did point out that 90.84 level, which we did hit and then come off, was one of the key levels to watch out. And I will retweet that piece because we were spot on with our levels there. That 50-day moving average really did act as key resistance and it smacked it back down. Okay. Right, hikes. Cable. I'm going to look at cable because there were a few of you looking at that. Obviously, we had inflation data just earlier. Inflation data was slightly weaker than expected. First time in about 5 years, I think, that we saw inflation at the 2% Bank of England target. But right now, the actual impact, I'll just go to the intraday chart, has been fairly limited. We had fallen to a low of 163.68, but buyers did come in. So the downside certainly is limited, but 164.50 is capping the upside in the very short term. As you can see here, we're really range bound. That inflation data wasn't enough to push us one way or the other. We're going to have to look towards Friday's payrolls. I think Friday's retail sales in the UK. I think that's going to be really important. Added to that, next week as well, we're going to get some important data, including the minutes from the Bank of England meeting. So that's going to be, really critical. If we go lower, we might have to see some dovish minutes that would hint maybe a changed forward guidance coming from the Bank of England in their February inflation report. So all of that is kind of weighing on it. But just looking at it from a slightly longer time frame, as you can see here, we still think this 166 level is the top. In fact, 165 after payrolls on Friday. Obviously, the dollar, sharp knee-jerk reaction lower. Dollar tanked, cable pushed higher. But the minute we got to 165, the sellers just came in and slammed it down. So as you can see, got a bit of a series of lower highs. And that is that suggests a bearish position to be in. But just looking at, let me just annotate this chart of where we could go in the very short term. As you can see, we're still hanging on. 163.50 is pretty good support there. It is the bottom of it's like trend line support. We're in a bit of a kind of triangle pattern at the moment, which really suggests that we're just treading water. So there's not too much to go on. Now that triangle is narrowing, which does suggest we could break out one side or the other. But certainly in the next kind of 24 hours, we may just kind of hover around here and there. Break below 163.50 is quite negative. Could take us to, let me just change my chart. 163.06 50-day moving average, and then as you can see these lows from 17th of December, which come in around about 162.30, then come into view. So this to me looks like we're in consolidation phase. Obviously it's a bit stomach churning for some of you. The cable also moved lower alongside. Cable was one of the weakest performers. In fact, let me just bring up that world currency ranking system. This is always a really nice way to get a good view of what's going on. So since the beginning of this week, the pound has been, since Friday, the pound has been the weakest performer, dropping 0.33%. Let me do that from 13. So from the beginning of this week, as you can see, the pound had been like the second biggest positive performer, but it has actually receded a bit. Swedish krona is doing pretty well. New Zealand dollar obviously doing very well. The euro is fairly flat, really. But the weakest ones, as you can see, yen, Australian dollar, CAD. These are the currencies that had all done really well after the payrolls. They're now kind of giving back a little bit of those gains. That's quite normal after a couple of days of really strong gains. But it does suggest that you should just be wary. Maybe that was just a temporary move, and that's what we do believe, that it was a temporary move, and that we could actually see, the Japanese yen, for example, strength in Japanese yen actually be limited, likewise with Aussie. So that is certainly something to point out. Now, obviously, in terms of what the dollar will do, we've got to look at Treasury yields. Treasury yields have had a rough ride, really. As you can see there, we dipped all the way to just above kind of 2.81% at one point yesterday, but we're now back testing 2.85. So we've come off for sure. It has certainly disrupted the uptrend that we were in. 3% was always going to be a tough level to break. Now, obviously, some people were saying, well, in the long term, we don't think the Fed is going to hike interest rates anytime soon. Look at some shorter term rates, and we will. The 5-year, for instance, had reached a 5-month high, I believe, earlier before the payrolls report, and then it sold off as well. So it's still as you can see, it's had a really hefty sell-off. It's still got quite a long way to go, but it does look like we could have made some medium-term tops. So again, yields are a key determinant of where currencies will go, and the US yield is stabilizing, but it's had a hefty sell-off. Milan, could I look at Aussie dollar? Manoj, yes, you talk about the cable and the moving average. I do look at them. So those two. So I looked at cable and I looked at dollar yen. They're both close to quite significant 200-month moving averages. Let me just get into them now. And I'll show you what I mean by, or why I think that this 166 level is a medium-term top, corresponds to the 200-month moving average. And let's just turn to sterling yen as well. To the level that we have noted in recent weeks. That 170, we'd broken above the 100 month. It looks like could potentially be a bit of a double top there, but we will have to see. Milan, yes, I did just talk about Aussie dollar. It's heading back to the downside. So thanks for pointing that out. Ian, that is great. So as you can see here, sterling yen, in our view, could potentially be just a little bit more constructive, certainly compared to sterling dollar, and that's because we are looking for the yen to weaken. If we look at the yen on a broad-based basis, on a trade-weighted yen, Oh, sorry about that, guys. As you can see here, it had strengthened, but it's still looking quite weak. A pullback is quite normal. So this goes to show, how much it has dropped. This is yen on a trade-weighted basis for the past 12 months, and it has had such a sharp fall. I mean, it had been 127, it then fell down to 110, or fell down to a low story around about 107, and now it's just pulling back a bit. So this, doesn't suggest the downtrend is over. If anything, just suggests a normal pullback. So it's quite difficult. It's a bit stomach churning, but it's worth kind of holding on. Now, someone wanted to know about earnings season. I'm going to end with stocks here. So if we just look at the SPX, for example, earnings season does, kicked off last Thursday with Alcoa. We get a lot of banking results this week. JP Morgan kicked things off. Goldman Sachs obviously will be a bellwether for investment banks. As you can see, we kind of dipped back. Whenever the candles really, really narrow, that probably won't go on for indefinitely. So always be wary, because the candles had really narrowed in the S&P 500, and then we get this big burst lower yesterday. So a bit of a delayed reaction, maybe to weak US economic fundamentals, maybe also to risks, people taking their money off the table ahead of earnings season. As we came into 2014, there were a couple of things that were on people's mind. Number one, the direction of stocks are going to be determined by Fed tapering. We know that now it's 10 billion a month. And if anything, the risk is that they maybe potentially stop that. And the other thing, of course, is earnings. How are companies doing? So we know the first part, the Fed part. We're just waiting for the earnings part now, and that could be, one of the reasons why people are taking money off the table. That's what we think. We don't think it's necessarily a change of trend. Trading out there is tough for sure. 1801, the 50-day moving average. As you can see, the pink line in the chart in front of you, that is your key level of support from here. That would be the lowest level since mid-December. And then obviously you get below there and you get to the December lows, around about that kind of 1765 to 70 level. We would expect them to act we'd expect the 50-day moving average to act as very strong support if we do get down there. That would be kind of our view from there. As you can see, in terms of volume, we have picked up for sure. Volume dipped really low, as it always does around about Christmas time, and since then it's been picking up. Not as much as it picked up, obviously, for the FOMC meeting, but this month's FOMC meeting at the end of January, definitely worth watching. So make sure you check our research, follow us on Twitter, so you can get all our previews and our ideas for that. What can we expect from earnings reports? Well, Bradley, this week is mainly banks. For banks, there are a couple of things that could weigh on profits. Number one, regulatory fees, legal fees. JP Morgan, I think, for 2013 had something in the range of $20 billion worth to pay for that. Added to that, some mortgage lending was weak because mortgage rates had gone up, which put people off borrowing. So it was mainly, the causes of banks' anemic performance could potentially be mortgage lending has slowed, legal and regulatory costs, and revenue from capital markets have been quite sluggish. Obviously volume was fairly weak the last quarter of the year. That could weigh on certain things. So that could mean that, revenues are lower, which is always quite negative for banks. But the one thing that we would point out in some bright spots of bank results could be banks are getting much better at controlling expenses, which can protect profits when revenues are low, and they are improving their capital position. So they are a bit kind of beefed up, which means that the regulators, that's a strong point. Legal settlement costs, though, are really, really key, Bradley. So watch out for them, because that could really be, even though these are one-off costs, they are hefty. And we know that kind of regulatory, issues and, fines have been, kept stock price, for example, like BP, very low for a long time. That could be the same for some banks. So do watch out for that. Alcoa, they're the bellwether. I know they're not on the S&P 500 anymore, but they disappointed when they released on Thursday, which sometimes sets the tone for the entire quarter. JP Morgan will release at 7 o'clock, so in half an hour. And there's lots of legal bills there that could be quite negative, could just, certainly it may not be a reason to buy, might be a reason for another sell-off. And Goldman will be another good gauge of overall investment banking performance. Really until kind of short-term interest rates are expected to rise or regulators loosen their grip, that could keep a limit on some banks, and some banks could really struggle. Where do I see euro dollar going? This will be our last piece. So yes, of course, I didn't look at euro dollar. I see euro dollar going sideways. I agree. Fabrice, for sure, definitely sideways. 137 is the high so far today, and that does seem to be a bit of a high. 136.18, obviously nice, support to the downside. It's had a bit more constructive outlook, compared to things like the Aussie, for example, compared to cable. But as you can see, as you remember from looking at that world currency ranking thing, the cable is pretty much, euro dollar is pretty much, it's up by 0.10% or 0.1%, not much at all. We still see that 138 as near term, as a medium term top. 137 near term resistance. So if we were to get above there, you'd then be looking at that 137.70 to 90 area. Okay, everybody. I think that's it. I'm just at my time limit. Thank you. I want to thank you so much for joining. We really appreciate it. You asked some great questions. I think we covered a lot of ground. And please do join us next week. We'll have another webinar next week. So please do join us then. But overall, everyone, thank you so much and good luck trading this week.